You probably don't need me to tell you that homes are unaffordable, but it's still nice when data comes out that validates the way that you're feeling, because now you have evidence, and hopefully that evidence can play some part in leading to change. NPR starts us off today. Home sales just posted their slowest May in 16 years. The home sales slump in the US continues. Last month was the slowest May for existing home sales since 2009, and you can probably guess what very famous thing happened in 2009 that led to essentially nobody buying houses. It was the housing crash. Existing home sales in May fell by 0.7% compared to the same month last year. Measured monthly, sales were up slightly, 0.8% from the month before, but that marks an increase from the slowest April for existing home sales in 16 years. So sales are essentially slowing down for the past 2 months in a row, even though there was a slight uptick, but generally what we're seeing is last month and this month are far lower than what we've seen over the last 16 years. And we're holding steady at that lower sales number, which indicates that people just aren't interested in buying homes right now, which is actually not that surprising when you look at the data. The National Association of Realtors chief economist Lawrence Yun called the sales figures, quote, very stable, but at the sluggish sales activity level. The key challenge is affordability, with median home prices up 52% compared to May 2019, while wages gained 30% over that same period, according to Yun. Meanwhile, sales activity is running at 75% of what it was pre-COVID, you've added. Right before COVID, the monthly payment for a home at the median price, including prevailing interest rate, was roughly $1,000 a month, Yoon said. Today, it's a little over $2,000, so that doubling in the monthly payment for a new set of buyers is hindering the market conditions. So when you think about the fact that the average price is up 50%, the average payments are up 100%, that's monthly payments, then it's no surprise that people aren't buying because wages in that same time are only up about 30%. They're not even coming close to keeping up with how much it costs to actually purchase a home. And this isn't just a since COVID issue. This has been an issue for decades now, where wages are not keeping up with how much prices of houses are increasing. We can see here charted the US median home prices versus income. And this is specifically a chart which I think is probably AI generated, at least this part, tracking what the median wage are and also the median price of a home. And as you can see here, it goes back to 1985, where the median wages, yes, we have seen an increase. There's been an increase in what we call real wages, which is wages adjusted for inflation. But what we've also seen is an absolutely huge increase in the median home price, far, far, far outstripping the median wage and income. As you can see in 1985, I think this is actually like 1983 or 1984, because I did fact check these numbers, it cost about 3.5 times your total annual income in order to purchase a house. And now where we are today, it costs almost 6 times that amount. Essentially, the affordability of a house has been cut in half. It now costs twice as much as it did relative to wages to actually buy a house. And there was some small correction here. We can see during the dot-com bubble, there was a tiny dip right after that. During the 2008 crisis, there was a pretty huge price drop, but then that recovered a little under a decade later. And then here during the 2020 COVID pandemic, we saw house prices go down, only for them to absolutely skyrocket and go very, very high. Now, to be fair, this chart was made when it was at its absolute worst. If we look at median home prices over the last, 23 years or something, we can see that after it peaked during the pandemic, or shortly after the pandemic, it has been coming down slightly since then, although it is still way, way higher than it was just half a decade ago. Despite the small correction that we've had in the last couple of years, the issue still remains. Housing disproportionately is outpacing wage growth. And to deal with this, people are doing two things. The first thing is something they're actually not doing. They're not buying houses. And the second thing is that they're choosing to, instead of buying houses, usually rent or just stay with their parents a little bit longer. And the choice to rent makes a lot of sense when you look at the data, because essentially everywhere it is cheaper to rent than it is to own a house right now, which is pretty surprising because owning a house is kind of touted as the American dream. You want to own a house, it's your path to freedom. But as of right now, it seems like it's actually not going that direction because houses are simply too expensive. Bankrate talks about this a little bit. The average monthly mortgage payment for a median priced home, $425,000 per Redfin in the United States, including average property taxes and homeowners insurance, rose 2.4% year over year to $2,768 as of February of 2025. In comparison, rents have remained stable year over year. The national average monthly rent came in at around $2,000 in February 2025 after accounting for monthly renters insurance and adjusting for inflation, down less than 2 percentage points since last year. Nationally, an average mortgage payment costs 38% more per month compared to the average rent. Bankrate's study found big city dwellers are often better off renting than buying a home, particularly in pricey coastal metros. San Francisco, for example, has had the widest gap between average rent and average mortgage payment over the last 2 years, followed by San Jose. It costs almost 191% more per month to pay a mortgage than to rent in San Francisco, according to Bankrate's estimates. And it's already hard enough to save save up money for a down payment on a house. But to save up money for a down payment and then also have to pay more than you were for rent or more than you would have to for renting an equivalent space, it's just a lot to ask for, especially when you take into account that you then have all the other normal expenses that come with owning a home. You got maintenance, repairs, lawn care, and so on. When you take all those factors into account, but most importantly, the affordability, it currently just makes more sense to rent. Now, there are other reasons that housing prices are dropping, and it's not just the renting thing, but before we get into those, if you like this kind of video, I post 1 or 2 times a week, and I'd love a subscription. So home sales are dropping because the price of those houses are going up faster than wages, but rent, on the other hand, on average, is actually pretty steady and relatively affordable. However, those aren't the only factors that are impacting home sales. High interest rates, the lock-in effect, and a general fear of economic downturn are also driving some people away from the idea of purchasing a house, and more towards the idea of renting or staying with parents for longer. For interest rates, they're higher than they've been in a long time, and it doesn't look like they're coming down anytime soon. Fed Chair Jerome Powell holds firm on interest rates, resisting pressure to cut. Federal Reserve Chair Jerome Powell reiterated his view that the central bank should keep interest rates steady for now, citing inflation risks from the U.S. tariffs. Powell, who made his remarks in a prepared testimony Tuesday before the House Committee on Financial Services, has been under pressure from Donald Trump to cut rates, which would make it cheaper for consumers and businesses to borrow money. In its June 18th meeting, the Fed maintained its benchmark rate in a range of 4.25% to 4.5%, where it's been parked since December. And high interest rates are not necessarily a bad thing because they help with inflation, and they do that by making it expensive to borrow money, which slows down demand and stops the economy from getting too hot and inflation from going up. And the people who can afford these higher interest rates have probably generally already bought houses and aren't looking to upgrade or swap to a new house anytime soon. And really, the only people that leaves are the people that couldn't afford these high interest rates, who are the people that are now renting. And it's pretty easy to see how much this is impacting people's mortgage and how much they're having to pay per month. Here's a calculator. If the home price is $400,000, you're putting 20% down, which is quite a lot, but just follow along for the sake of argument here. You do all these calculations with the 6.7% interest rate, and you're paying about $2,069 per month. But let's say this interest rate is 3.5%, which is closer to what it would have been a little while ago, and you calculate that, and look at that. It's $1,400 a month. That's basically a $600 a month difference. That's a huge amount. You extrapolate that over the course of a year, 10 years, 15, over the course of a 30-year mortgage, that's a lot of money. And you can also see this here. Look at this. The total amount that you're going to pay for the house is $517,000 with a home price of $400,000. But then if we go back to how much it was when this interest rate was 6.722%, the total you're paying for the house is $745,000. That's like almost $250,000 more just because the interest rate was higher. Nothing else about this equation has changed. That's how badly these high interest rates are affecting people's ability to purchase houses. And the result of that is not only the home sales numbers dropping like we've been seeing, but it also leads to this thing called the lock-in effect, where people who are living in their houses are far more reluctant to sell their houses because they are locked in at a lower interest rate. If they were to sell their houses and get a new mortgage, they'd have to go up to this 6.7% interest rate instead of staying at the 2.5%, 3.5% that they're currently at. And this kind of leads to a domino effect because generally over the course of people's lives, they move up in houses. They earn more money, or they have larger families, or they get married, etc., etc. They sell their old houses and they buy nicer, newer, bigger houses. This allows the old houses to be bought by other people who don't have very much money and were in the same stage of life as the homeowners were a few years ago. But if people aren't moving up in house because they don't want to give up their nice interest rate, then that means there's no longer enough houses for people entering the market to be able to purchase those. So they're stuck either renting or paying way more. So we've got high interest rates and the lock-in effect that are keeping home sales low. And the final reason for this slowdown that we're seeing is people are just generally pretty pessimistic about the economy. You can read more about it here. Americans continue to have a bleak outlook on the economy. Consumer sentiment fell for the 4th straight month, according to a survey from the University of Michigan. The index of consumer sentiment in April was 52.2, down 8% from March and down 32% from January. That's a huge, huge drop. Consumers perceived risks to multiple aspects of the economy, in large part due to ongoing uncertainty around trade policy and the potential for resurgence of inflation looming ahead, said Joanna Somebody, the director of surveys of consumers at the University of Michigan, wrote. The data from the surveys matches other recent polling on consumer sentiment, which is just to say that the other polls also show that people are very pessimistic about the economy. And if you think this through logically, it kind of makes sense that people would be hesitant to buy a house if they think that the economy is going to make a downturn. 30 years is a long time to be locked into a mortgage when you think there's a chance that you might lose your job or your company might start losing profits. Renting, on the other hand, is much safer because you have a 1-year lease and you can always downgrade if you need to, or you can purchase a home after a year if the economy turns out not not to be quite so bad. Smaller 1-year commitments are a lot easier to swallow than a 30-year commitment if you're not sure what's going to go on with tariffs or other geopolitical happenings that are going on right now. The one bright side to all of this is that when demand goes down, as it is right now, usually so do prices. So if this demand continues to slow down and maybe we get a rate cut in the next year or so, then housing might actually start to become affordable again, or at least move in the right direction. Thanks for watching.